Good evening. It's Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, here with you on the 26th of July. This is right before, 26th of July. We're right before the big Fed day tomorrow, Wednesday. And we thought it would be appropriate to get out this little video, giving us some context, giving you some context on what we're seeing out there in the markets and the economy. So allow me to share my screen, and we will go through a few slides, and look forward to doing so. So let's just see how, okay. Thank you for your patience. Okay, so allow us to talk a moment about what our take at ALINE Wealth means. You've heard of this term before, of course. Every economist, market strategist, individual financial advisor all have, or they should have, their sort of take on things and how they see the markets, economy, strategy, world. And we have one too. However, it is not a house view. At ALINE Wealth, we don't do house views. We're independent thinkers. We embrace the spirited debate within our firm, within our community of advisors and colleagues around the country, and we welcome this spirited debate that allows us to put forth our thinking and to understand how we see the path forward. For without a path forward, you get stuck on that twisty road you saw in the previous slide. So we need to have a path forward. Our take sort of codifies our thinking in doing so. But again, it's not a house view. We're independent thinkers, and to that end, there may be some nuances, let's say, to our overall baseline. We curate information, we confirm it, we test it, we stress test it. We like to say that we observe facts rather than forecast. We are in the business, as you all well know, of understanding our clients very, very well. That's what we do at ALINE Wealth. Well, we do the same thing with the capital markets, right? We want to understand what's going on there very, very well, so that we can best position our clients' portfolios. So as CIO of ALINE Wealth, I am afforded this platform. So let us simply say that this take is essentially a baseline, okay? Okay, so what is it? Where are we? Well, we think that there's a regime change occurring, and after 40 plus years, markets have been buoyed by ever decreasing interest rates. The price of money has come down year after year since 1982, and essentially went to zero a couple of years ago. And this greatest bull market of history, or in history of credit, has provided wind at the backs of investors, speculators, and consumers, right? It's been a great 40-year run. Inflation, which is the reason why the price of money came down, is that inflation was essentially slayed through a confluence of events unlikely to repeat themselves, which are, globalization, right? We exported inflation by producing goods abroad, right? And much less expensive to do that in Indonesia and China, India, Mexico. And of course, that helped. The collapse of USSR, the collapse of communism, or at least there, has helped reduce the cost of goods. In technology enhancements, immigration, these issues have helped slay inflation. But allow me to frame this a bit with a little economic story, a little history lesson. So we all know of Chairman Volcker, who came in to the Fed in the early 80s under President Reagan after a 10-year stint of the former Fed chief Burns, who really was, frankly, ineffectual. And this big Volcker, this 6'7" guy and a big cigar, he was really something. And he really said, I'm just going to do what it takes to slay inflation. And he had the wherewithal to do so, and the political leeway to do so, and he did, but it cost us two pretty nasty recessions along the way. But once done, it opened up the floodgates of growth and opportunity and entrepreneurialism, and a huge run in markets around the world. And again, like I said before, there was a confluence of opportunities that are probably never going to be repeated again, like the opening of the emerging markets, which really helped both on the demand side as well as the supply side. Byproducts of this run, right, of this slaying of inflation and this reducing of interest rates consistently for years, were obviously lower interest rates, but from there came multiple expansion, right? It used to be PEs of 12, 13 were common. We sort of ratcheted that up over the last couple of decades. Increased risk taking, right? The Fed we got the protection. The Fed'll handle it. They'll come and save our back. The moral hazard that was out there. You had the democratization of markets where everybody was investing. Swimming without one's trunks. That's a quip that Warren Buffett is fond of saying, which is essentially when the tide goes out, you realize who's been swimming naked, who's the master of hubris, right? And who's been able to sort of command an audience without really having any data to support it, that kind of thing. And so we have these issues. Consumption went up, housing went up because interest rates were lower, M&A went up because you could get the deals done at lower costs. Lots of things were happening, all on the back of lower and lower and lower interest rates. Well, folks, that game seems to be played. So we're on to a new regime and a new playbook. Unless you forgot, there's been a lot of money made during the 1970s, and investors like Warren Buffett and his value brethren did extremely well because they had the right playbook. So don't think that because we're in a different regime that making returns will be impossible. It is not. It may be harder. It may require a new toolbox, but it is certainly doable. And here's a little bit about that. So you need to be more active and engaged. You got to know what you own and the thesis behind it. It's no longer good enough just to own something, throw a dart against the wall. And frankly, that's how people made money for many years. That game, I think, is over. I believe now we need to be a bit more focused and active and more fundamentally focused on markets as well. Like I said, the globalization is now the new expectation, right? So you're not going to have that export of inflation and the lowering of rates that caused that or that came from that. You'll have near sourcing because of post-COVID, companies realize they need to have their goods here. That's going to be inflationary. Labor strength, you saw what's happening at Starbucks and Amazon. Labor is getting more, is exercising their muscles. A little story on that. I was on the Long Island Railroad recently, and a lovely young couple was next to me, and one of the fellow gets off, maybe a boyfriend or a husband, and he says, "Goodbye, honey," and his wife or girlfriend says, "Don't work too hard. They're not paying you enough." That kind, again, that's all good. But I think the country is moving more towards that kind of scenario where labor now has an upper hand. That's inflationary. I'm not saying it's good or bad. I'm simply observing what's going on out there and the implications for portfolio management. Clearly, ESG and decarbonization standards, again, good, but be careful what you wish for when you have a movement that moves before the horse. You're putting the cart before the proverbial horse here. We didn't have the infrastructure available to go green so quickly, and that's what's causing a lot of the inflationary pressures. You realize there has not been a new aluminum smelting plant built in 20 years, a copper mine in 50 years. There's been a lot of held back supply that's now causing a good deal of inflation because of the demand is still there and increasing largely due to our movement to net zero by 2050. Again, good, but it has its implications. And, I use this idea here. Remember back in, I guess I'm dating myself, that, 20, 30 years ago, there was a program on Friday nights, and it was on Channel 13, to give you a sense of the kind of program it was. Louis Rukeyser's Wall Street Week. And I know there's a new Wall Street Week, it's great. But this guy was an old-fashioned kind of stock analyst guy. My wife used to be so bored by this, but I liked it. And it really was a staid kind of, I don't know, more an analytical kind of program that focused on Wall Street. I think we're going back to those days where fundamentals matter, where value style is in favor. To that end, the playbook should be more resource-based companies with pricing power, more commodities. Perhaps commodities have done nothing except for the last year or so in 20 years. So, I mean, now they're overdue, and again, less bonds because of potentially higher continued interest rate movement higher, and of course, less high multiple stocks. Just too much risk there. So digging into this new playbook for a moment, if you allow me, here's some data to support some of our thinking. So investors are not seeing it yet, and they should. What they're not seeing is the disconnect between earnings and valuation and market price. And this is some work from our friends at GMO that looks at the PE for 10 years smoothed, right? The CAPE index, as we call it, cyclically adjusted PE ratio, predicted by GMO through their very strong analytical work focused on return on equity, inflation volatility, and GDP volatility. Look at the correlation between their expected PE 10 and the market's realized PE 10. Pretty tight. And then it gets a little wacky, right? We know that bubble. And GMO sold all their tech stocks in 2000, and they lost clients because of it. They all came back a couple of years later. So these guys, stick to their knitting. It's very interesting. And so very, very correlated in all. Now you can see the opposite here. What's happening here? Same things almost here. So this is interesting to us. And so we need to sort of keep our careful eyes on this. Again, 10x to sales. 10x to sales. We're still up here. We've come down, don't get me wrong. But there's still plenty of companies. And when I do my screening, I still see plenty of companies that are traded, that are trading at more than 10 times sales. That's just too high. And especially given the new, as interest rates go higher, that's going to really throw some cold water on those types of valuation metrics. So we've got to be sensitive to that. They are coming down. They are correcting. There's been a lot of bloodletting in some of these high PE stocks, high price to sales stocks, excuse me. But there's still plenty out there, so we need to be mindful. Here's Buffett's indicator comparing the country's GDP to its market price, like a big fat PE ratio. And as you see, it's come down, but it's still pretty high. So again, we're not there yet. We still have some work to do here. Again, here we see the similar correlation between earnings, 12-month forward earnings per share versus change in price, right? And you could see how the price has gone parabolic for a period of time there versus its earnings, and now you'll see the price coming in. The thing you need to be careful here is that regressions to the mean require price to go below just to get back to average, or to correct statistically correct for this overdoing of the mean. We need to come down lower to get back to a mean. So that means that would mean that we would go lower for a bit to get back to this average. Okay, remember commodities? We talked about them a little bit. I think there is an opportunity here to have a higher weighting. Again, we always want to be balanced, right? It's just working the edges here. That's what we're doing. We're working the edges. But commodities is certainly something that's been out of favor for a good long time. Here you'll see investments in the energy sector held low. Maybe this is ESG. It's definitely part of that, clearly. And yet demand has been still very high. What happens here? Without investment in CapEx spending in the infrastructure to make the product, it's going to be more expensive for them then to make more products and gear up. They're not gearing up. And so therefore there's a scarcity of that commodity, which means price goes higher. That's what we're seeing. And we could see that in plenty of other commodities, by the way, from copper to aluminum to the green metals that are so critical for the green, the movement to 2050. So here's a graph that shows us how commodities fare in low and rising inflation. Well, we're not really there. We're here. High, maybe plateauing inflation, perhaps. And you can see how it does, how each asset class do in these types of environments. Obviously, commodities, gold, to a lesser extent, REITs scream as opportunities. And we are focusing a bit on these areas. Doesn't mean we're not doing the others, we're just, again, reducing weightings. This is, again, from GMO, and here we're talking about how we're seeing the MSCI growth value. So again, here, the value style is not only cheap, but probably very opportunistic at these levels. And you'll see it here, very cheap, considering this particular graph, which is looking at the cheapest 50% of US stocks. So value, which is buying stocks, or it's a style of investment that allows us to buy with a margin of safety. We're looking to buy investments worth X for below X. So sometimes you're dealing with companies that have issues, sometimes misunderstood, sometimes not sexy or boring, and not in an index. All right, that's really key. So they're forgotten. That's where a keen analyst who's doing the hard work, who's doing the heavy lifting of fundamental analysis can find these opportunities, and they can be well rewarded now more than they have in the last 25 years. Because now there is a movement, we believe, towards value. And you could see in this particular slide, which is a setup for the next slide, you could see that in bear markets, investors can do very well. You know, the old adage rings true. You make your best returns, or your most money, in bear markets. You just don't know it for 10, 12 months. And so what this is showing you is markets go down, ergo bear. 6 months later, look what's happened. Even in recessionary periods, they're flattish, right? In non-recession, they jump. So I'm not sure where we are, but we're probably between these two somewhere. But 12 months later, 1 year, snap of the fingers, look what's going on. And I bet if you, again, you're never going to time the bottom, but if you consistently buy when markets get cheaper, you can probably do better than these averages, right? That's what we aim to do. So this is a slide that shows you that indeed money can be made in bear markets in difficult periods. I want to highlight the 70s here and the 80s period where you had big contractions of wealth and markets, down 46, down 24, down. And look what happened with the lowest PE stocks, right? Boom, 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 all up. Because they're taking advantage of opportunities, number one, plus they're fishing in a different pond. They're not fishing in the hot, nifty pond with overdone multiples of valuation. And so when these contract, they contract hard because they're way up. Where the value stocks, have an opportunity to receive inflows and continue to go higher. So folks, thank you very much for the opportunity to speak with you today, and I'm wishing you and yours a happy balance of the summer. And by all means, reach out to Align Wealth for any of your questions or comments. We're here to talk with you, to go through your wealth management plan, and to focus on your life plan to get you from where you are today to where you want to be in 5, 10, 15 years. Thanks again. Take care.